Now for more detail on what this means for the market, I'm joined by Mark Todd from FIIG Securities in Sydney. Mark, great to have you on board. Look, we sort of touched on this a little bit yesterday. We've had now, I suppose, a day to absorb it, at least the market has been. What's sort of the response been at this idea of trying to deepen it and flesh out the corporate bond market?
Hi, good morning. I think it'd be fair to say, James, that the market would be happy to see that the fact that the Treasurer's articulated a position that a lot of people in the bond market have been saying that there's an underweight in the fixed income piece. So if you have 16% of your self-managed super funds in the form of debt or cash markets, you need to move that along to higher numbers. So it's good to hear the Treasurer speaking about that. There's again clearly some concerns about how it's all going to evolve, but we're in that evolutionary stage at the moment. So there's nothing clear that we're going to be able to point to say that's a good decision, but the idea that the Treasurer is talking about it is a very good decision.
Look, what I'd imagine is clear will be the general appetite for it. You just have to look at something like the Woolies notes, for example. I mean, huge appetite for it. Do you think the retail base is there?
Oh, clearly it's there. I mean, we're seeing extraordinary growth in our business at the moment, with the demand moving around from the equity piece coming into our salespeople behind me. They're busy every day. They say they're too busy, to be honest, but there's a lot of people coming through saying, I just want a consistent return. As I mentioned yesterday, the equity story is hard. It's just on a repeat switch. It's a good time to buy. So a lot of people have moved on, and the ageing of the population is a very significant factor in that moving. So people want to enjoy that retirement. It's a good story for them.
So who are you getting in? I mean, where are you seeing the biggest amount of growth? Is it in those people switching to self-managed super funds?
Self-managed super funds is a big part of the business. That is true. I mean, down here we'll talk to the entire street. So we talk to all the investment banks, we talk to all the funds, and all the self-managed super funds. So it's a broad, diverse collection of customers at the moment, and it's meeting the same demand. There'll be the funds coming to either reposition a portfolio. You might have, some of these funds are enormous. There'll be a $5 billion fund and it needs to shift some paper to rebalance, and so that's where they'll come to us and look for that diversity in that sale, where they'll be able to sell to 1,000 customers who might want to buy a Telstra. So there's an opportunity there for everyone at the moment.
Look, I want to get your thoughts on the plight of the banks at the moment. Obviously very much in focus. 3 out of the big 4 having their AGMs this week. Indeed, Westpac's happening at the moment. Interesting to see some of the commentary coming from Gail Kelly, the CEO. A lot of talk at the moment about funding cost pressures, the impact on margins, particularly, I suppose, coming from those offshore wholesale funding markets.
Sure. So we saw the NAB issue some paper yesterday at 130 over, which is about 15 basis points higher than it had been the previous week. I think the issue around all the majors trying to articulate the cost of funding offshore is that they've done a poor job. They haven't been able to explain how the movement within the credit agencies has meant that everybody is getting more conservative. It's not a function of the banks being poor borrowers. It's a function of the lender being naturally conservative and going into treasuries and looking for a conservative bias towards the end of the year. So there is legitimate pressure, and we are seeing it in the term deposit piece where people are paying up for good term deposit rates down here, but we're also seeing it in the offshore piece where that corporate activity in buying their bonds, they're looking for an extra 10 or 15 basis points to take on the risk at this point in time.
Is that risk going to be heightened at all with the re-rating, the downgrading ratings that we've seen of our banks, but also I suppose globally? It just seems like all banks at the moment on the chopping block, and the flow-through effects then to access to funding.
That's right. So there is a point around which everybody who's lending money to the financials is starting to look for something like a Woolies. So the Woolies and the Telstras of the world become quite attractive to rebalance your own book, that you're heavily overweight in financials. As a consequence, when you see that Moody's and S&P start to regrade some of the investments, and there's a point around how they're doing that the client will send the signal back to the borrower saying, look, I need an extra 15 points because of what the rating agencies have done. Not that I don't think that you're fundamentally a sound credit. I'm just looking at what drives my investment criteria, and part of it will be what a Moody's and S&P will characterise you as. And that's a trick. It's a trick that Moody's and S&P, if we're critical of the banks, we can be critical of the ratings agencies in the way they've articulated the ratings. I, a rating agency, am getting more conservative, so the aid that I'm giving that specific borrower should be deemed to be a much more solid aid than it had been in, say, 2008.
All right, Mark, got to leave it there. Good to talk as always. Thanks a lot.